Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph program. Let's continue our discussion on the 2018 tax changes. One of the next areas we want to talk about is the teacher's deduction. So what this did is it allowed teachers to deduct up to $250 of classroom supplies and professional development courses. And I'm happy to report that that is staying in the new tax code. Let's talk about moving expenses. So moving expenses was allowing people to take a deduction for moving expenses for job-related move where the commute is 50 miles further than before. And qualifying moving expense reimbursements were excluded from the employee's gross income if they were paid for by your employer. Big change here. So the deduction is eliminated except for those folks who are in the military. And this money that was paid as a reimbursement to the employee will now be included as taxable wages. So what does this mean in practice? If you're moving and your business or your company is paying for that move, be prepared that that is not going to be a tax-free move anymore. It's going to be something that they're going to have to include in your gross income. Next area. Right now, the person who pays alimony is able to claim an above the line deduction, basically mean before we arrive at a gross income on any money they pay for alimony, and the person receiving that alimony has to include that as income. Well, now for any divorce agreements entered into after December 31st, 2018, or existing agreements that are modified after that date, that will no longer be the case. So after 2018, you will not be able to deduct the cost of alimony, nor will the person receiving it be required to claim that as income. Now, if you're in an existing agreement, that isn't going to change anything unless it's somehow modified. So that's an area to keep in mind. The next area is that of bicycle commuting. And I thought I'd throw this one out there because this is kind of a funny one. But right now, the current law allows reimbursements of $20 per month as tax-free compensation to employees. The new tax code completely eliminates that. Another area, employer-provided housing. Right now, there's an allowance for exclusion from income for the cost of housing provided for an employee for the convenience of the employer. This is being retained in the new bill. So that is something that was hard fought out between the Senate and the House Representatives, but it was retained. Dependent care assistance. So this allows an exclusion for gross income up to $5,000 per year for employee-provided dependent care expenses. This was something that we thought may be on the chopping block as well, but it was retained as part of the conference agreement. So if you have a flexible spending agreement at work and you're able to defer $5,000 of income, basically making it not taxable income, that's going to continue to move forward. Another area that was considered to be an area where it could be going away is adoption assistance. Right now, an employee can exclude a maximum of $13,570 for qualified adoption expenses paid or reimbursed by an employer, and it's phased out based on your income. Again, we thought this was one that may go away, but it was decided they were going to keep this in the bill. Let's talk about tax rates in general. So tax rates right now, there are 7 tax brackets, and I'm not going to get into speaking all of them. They're going to continue to be 7 brackets moving forward, but the brackets are going to change. So for example, right now we have a 10, 15, 25, 28. In the new tax bill, there's going to be a 10, 12, 22, 24, 32, 35. And the top rate, which you've heard a little bit talked about in the press right now, is 39.6%, and it's going to drop to 37%. So for our really high income individuals, they are going to see a tax reduction here as well. Now, another area is the identification of stocks being sold. So under current tax law, a taxpayer who disposes of part of his shares in a corporation that were acquired at different times and for different prices is allowed to choose which shares are considered sold if they are adequately identified. Now, I don't want to get into a big discussion, but it's a whole discussion of first in, first out, last in, last out. But the Senate version of the bill would have required using the first in, first out method. However, the final bill does not include this requirement. So again, we thought there might be a change there, but there is not going to be a change. Now, something that will affect anybody with children less than 17 years old is the child tax credit. I know this has been talked about a lot in the press as well. Currently, there's $1,000 per child qualified tax credit for those children under 17. Now, this is reduced if your income reaches certain levels. Now, one of the things, and it's also what's called a refundable credit. So refundable credit equal to 15% of the earned income in excess of $3,000. And I don't want to get into a big discussion about that. But basically what that means is even if you don't have any tax liability, you could still get child tax credit. Now, the new law retains that age 17 requirement, but what it does is it increases the child tax credit up to $2,000. So my suspicion is the thought here in the first podcast or broadcast, we talked about the part one of this. We talked about the removal of the exemptions. Well, this is where they're making up for a little bit of that by doubling the child tax credit. The other thing this does, it also increases the phase out, so that won't be a big issue. Now, one of the things they've added that wasn't in the current tax code is a provision for non-child dependent credits. And what they're allowing now moving forward is a $500 non-refundable credit for non-child dependents. Now, one of the things a lot of my clients ask me about is what's the dreaded AMT, I call it the Robin Hood tax, but alternative minimum tax. They're leaving this in place, but what they're doing is increasing the bottom threshold for that. So currently, exemption amounts are at $84,500 for married. They're going to increase that to $109,400, and for a married filing joint, they're going from $42,250 to $54,700. So that will be a bit of an improvement. Now, under the area of corporations or artificial entities, the big change here is this whole discussion about pass-through entities. And this is something that we're still going to have to really study because it's something that's going to impact anybody who is a owner of an LLC or a subchapter S corporation. And basically, since they've passed along this new corporate tax rate of 21%, one of the things they wanted to do is to push this to the folks who are pass-through entities. In other words, let's say you're a small business person that files your return as an S corporation or an LLC. So what this act provides is a 20% reduction for pass-through income. Now, here's where it gets complicated. Limited to the greater of 1, 50% of wage income, or 2, 25% of the wages income plus 2.5 of the cost of tangible depreciable property for qualifying business. Now look, this is the bottom line with this. Congress makes the law, the IRS writes the code and writes the procedures that are going to be used. This is something we're going to have to keep an eye on because I really don't know at this moment how this is going to play out. The good news is it's the income from the pass-through, so that would tell me that it's the net income, not the gross income. Now, also on the business side, one other cool thing that they've changed here, and that is the ability to write off 100% of tangible business assets. So what this potentially could do is really spur some growth of businesses spending money for capital projects. Well, I hope this has been helpful to you looking at this tax change, and I'm sure in the future I'll be talking more about some of the specifics once these go into place. Thanks a lot.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.